Property Investing Insights, your authority on all things property investing, finance and wealth creation with Right Property Group.
G'day, how you going? Phil Tarrant, one of your co-hosts on Property Investing Insights, one of the original podcasts for property investing. Who would have thought? Part of the Property Investment Podcast Network. We've been doing this in conjunction with our friends over at Right Property Group. That's RIGHT Property Group, many years. Probably one of the original buyers agents, I'm thinking. Victor Kumar, Reshmi Kumar, my guess. Victor, you probably know, don't you?
Yeah.
You're probably a second generation. I think it was one generation.
There was one generation. There's a handful before us, and a few of them are still around.
Yeah.
Others have gone on to retirement villages.
They have done.
But they really, when we started, we had to explain what a buyer's agent does, right?
Yeah.
And particularly to the agents.
We had huge resistance as well.
Yeah, what are you doing? Get out of the way. I want to deal directly with the buyer.
Yep.
You're going to make the buyer smarter. Don't do that. We don't want anything to do with that.
Yeah.
I've been, and you guys were just the beneficiaries of an off-air rant of mine, which I...
and I'm still scarred about that.
which I sort of... Yeah, I'm just forming some views and opinions right now, and I'm not yet ready to express them, but it's about the buyer's agent sector in general, whether or not it's actually the right name for a buyer's agent. But I would put you guys as the second generation, early second generation, and as a latter part of that second generation. So I'd say the very original buyer's agents. Mm-hmm. You guys were probably the start of the second generation of buyer's agent. That is, hang on a second, there's something in this. This is going to turn into an industry. You guys have been at it for 20 years, right?
20 odd years.
Yeah.
At the back end of that second generation, you had, probably they started emerging about 7 or 8 years ago. Many of them were probably your clients at a point.
They are. We actually did.
You're like the Aussie home loans of buyers, and that's a compliment because Aussie home loans created many of the best brokers and people that went on to create and create. So you, a lot of those people out there got their introduction to buyer's agency probably being a client of yours.
Absolutely.
That's something you should be proud of, by the way.
Yeah, we are. We're in a unique position where we've created our own competition. If we could call it competition.
Well, you've created a market in some ways, right. Amongst, I would say, a handful of other very good and capable buyer's agents, similar vintage of yours. And there I'll talk about guys like Ben Kingsley, for example. That really early second generation guys created pretty much the market.
So we did a count. It was in the team meeting, I think, 2 weeks ago. And I think it was 67 or 68 buyer's agencies we've created.
No.
Yep.
Is it that many?
It's that many. Yeah.
God.
Yeah.
That's actually quite a lot.
It is a lot. And no, if you look at it.
We did a good job.
Yeah, we did a good job, right?
We did a good job.
So if you really look at it, we started the task of sourcing properties and setting up strategies back in 2001.
Yeah.
Right? And then good old Steve came along in 2008-9, and that's when we had a name change to Right Property Group.
Yeah.
Right? And before that it was Right Group. And so if we look at that historical, there's a lot of people we've helped, a lot of market cycles, and a lot of wealth we've created. And the natural progression is when we taught people how to fish, right? And now they're hung up their own shingle and carrying on the good work.
Yeah. I think it's great. It should be acknowledged. And most of those 60 plus buyers agents that emerged out of probably using your service, most of them are pretty good operators. I could probably count some of them I know personally. Mm-hmm. Yeah. He smiles, he smirks.
I know.
Not all of them. Yeah.
He whose name shall not be taken.
Oh, gosh.
Do you sort of see them out? You still go out and look at stuff?
Yeah.
Do you see them out there?
Look, most of them don't go out and look anymore. They get, their team members to go and have a look, right? I still, it's an outing for me, right? So I go and look. It keeps my eye in. It keeps me in the goss in terms of what's happening in the area.
Yeah.
Looking at the opportunities based on our years of investing. It does give you the aha moments and opportunities that even the agents might not see.
Yeah.
And it might not be that property. It's just comes out in conversation.
When was the last time you saw him get excited about a property, Reshmi? Was it every property still? He comes home going, I just went out here and...
The investment side, yes. I think because of the constructions that's happening, so those were those properties. But you flicked me one the other day, which was a property we were looking at maybe for ourselves.
More of a lifestyle property.
Property. Yeah, that was only like a couple of days ago. So yeah, it's still happening.
A lifestyle property. Yeah. Is that what everyone's getting into these days? Is it?
And that's the word where it's sort of like not a financially smart decision. It is more like, okay, I can see myself living here and enjoying.
I've got one of them. Lifestyle property typically means expensive.
Found one in Sunshine Coast, right? My absolute. Property that I wanted.
Ticked all the boxes.
Yeah, ticked all the boxes. Beach.
Yep.
And then walk to your lawn.
Yeah, that's good.
And that's the house. It's still there on the market.
Is it?
Yeah.
I'm going to send you right now a property, if you want a lifestyle property. I'm not going to tell everyone what it is, but anyway, I'll do that. And if that's what you want, I've got one for you.
Okay.
My fee.
This is a standalone house.
My fee is
a cup of coffee.
A cup of coffee is all I need. But yeah, it's good, and you don't have to travel that far.
Oh.
But I like I guess it's one of the benefits of investing in property is going to be a great enabler for creating opportunities. To have a point when you can have a laugh about having a lifestyle property.
Yeah, when you get to that stage, right? And obviously, when we started, it was sort of unreachable.
Yeah.
And now it's sort of like, okay, I can buy that, but should I?
Yeah. But now you can and go, I can cover that and it'll be right.
I know a time I said, but there's 50,000 to be made if we get into this property now instantly, 3 months' time, 6 months' time. If we did this, there's 50,000. And he might say, but that's not what we need for our portfolio. We are looking for something more than that. And I'm like, well, that's $50,000.
And this is probably sage counsel for most people tuning into this. And a really good buyer's agent or property strategist, and I'd say you guys are property strategists, you've got to make sure when you're working with someone that's helping you down this pathway of wealth creation to actually really be clear about what you want. A lot of people invest in property with this idea that it's going to give them some sort of retirement, right? Absolutely. At a point in time. But they need to work diligently through this pathway to get to a point of time when they could stop working and then realise the value of their property portfolio. I tend to see it a little bit different. I don't want to wait that long to actually enjoy the fruits of my labour. No. So I'm happy to calibrate a portfolio which allows me to essentially do both. That is, enjoy it on the way.
Yes.
And don't wait for 20 or 30 years to buy some dream property. Like, for the purpose of lifestyle, if you can build and do your things right, do it early on because you want to do it when you're younger.
Oh, yeah.
Don't wait till then.
No.
Do it as early as you can. So there you go. What do you can do lifestyle property experts now, right? but the two can run in. It can run in conjunction, right, Reshmi?
See, before people didn't know many strategies, right?
Yeah.
There are not many people investing, and it was more like all you hear about is buy and hold, and so you wait for the time. But there's so many strategies out there that you can be dynamic as you can. So whilst you're investing, you continue with your normal lifestyle, balanced lifestyle, and just invest and use the different strategies to, in the background and keep investing and keep enjoying the fruits of your labor.
There you go.
Yeah.
All right.
In fact, I can't miss this opportunity, right? On 3rd September, we're going to talk about the 3 key strategies in terms of building a portfolio at Parramatta Region.
Oh, here we go.
So,
There's a plug.
There's a plug.
He can't help himself, people.
Yeah, I mean, it's interesting. So before with that, this whole thing that we're doing on 3rd of September, that was all about educating people about property investing.
So this is your bringing back...
Right on track.
Right on track. Look at that. You love this. Bring them back right on track. And I went to Right on Track quite a few times.
You did,
early doors, and it's where a lot of.
Those were the days when there were less people coming because you came.
Yeah. This is true. And it used to be at Ridges Parramatta.
Yes.
It's at Ridges
Parramatta.
You're back at Ridges Parra.
Yep.
I thought it was at Rouse Hill for some reason.
No.
Oh, I must have misread that. Okay, Ridges Parramatta. You're back at Rose Hill.
Yeah,
Rose Hill. There you go. Yeah, you're right. So Ridges Parra, opposite.
Say that again.
Rose Hill.
No, I'm right.
You're right. And I've been to it. It's next Tuesday, is it?
Yes.
Okay. I noticed you haven't invited me, but I got to pay,
look
right?
at your emails.
but it's really easy. By the way, if you're thinking about, if you're in Sydney at least, super easy to get there. If you're coming from town, now that you got the new
Metro.
You got the new Metro. You've got the tunnel coming out of Sydney. Like you can get there from Sydney. What time to start?
It's 6:30.
6 o'clock. Yeah, you'd be able to leave town and get out there. Really easy parking. Really, I'd encourage people to do that. It's nice to actually meet and greet other property investors. Have a biscuit and an international roast coffee is normally what you
That's
serve out there.
Yeah. No wines,
No wines,
cheese,
no nothing.
Yeah.
No.
Yeah, but the biggest plus for that forum is actually not necessarily talking to me or Reshmi. It's talking to the other investors that are in that journey or have gone through a stage of the journey that you're going through right now, because it gives you a insight of what's in store and what's possible. It opens up horizons. It also keeps in check to say, okay, this guy's told me if I did this is how it impacted me, and I better not do it.
Yeah, it's good. So people can
jump on the website and
yeah.
there's a link. Just register to attend.
Okay, rightpropertygroup.com.au. All right, go and check it out. Yeah, you'll enjoy it. I know a lot of people they get addicted to it, right? Go to all the time. But that's not what I wanted to talk to you about today. I wanted to talk to you about something. And again, I'm still sort of forming my view on it. And I think we probably spoke about this well over a year ago. And I've been watching it play out. And for the smart operator, I think there's something in it. And that is the widening disparity between the prices of houses and units. And look, it's a bit of a blanket statement because this sort of the gap between the value of a house and a gap between and a unit in different parts of Australia is always going to be very, very different. So I'll preface with that point. However, the general trend or theme I'm seeing is that gap is getting wider and wider, which says to me either houses are overcooked and overvalued or units are undervalued. And I think it's the latter rather than the former.
Absolutely. And I really think that if you look at it from a historical point of view, right, there's usually is a gap between houses and units, right? And rightly so, houses got more land content on it. But I think people, given COVID, given what we've come through, the messaging is lost in terms of how to build a portfolio, right? It's yes, you put the bigger rocks in the jar as well, but you need to put the smaller rocks to fill the gaps, right? And if you're just starting out, I mean, we started with a unit, right?
Yeah, our first couple of properties were units, actually.
Yeah, so because that was affordability, right? We had a small deposit, we couldn't qualify for as high a loan, and we bought, right? What most people tend to hang their hat on is all of the negative news and the negative impact of buying units. And it's probably because they've bought the wrong units for their portfolio, for their circumstances.
Yeah, and most of those people probably bought an off-plan property somewhere in a high-density block. That's probably the reason why there's a blanket idea around that, Reshmi.
Yeah, no, I just thought there are lots of factors in determining whether it's a good one or not. You know, so there are lots of ways to look at it in terms of when you said buying property. Yeah.
And just like buying houses, right? So the areas that you would buy houses, the areas you would not, and areas that you would buy that will perform really well, and other areas that will not perform as well. Units are exactly the same. It comes back to what the pipeline of supply is. And we need to be really careful not to get caught up in the numbers game, but also look at it from a logical point of view as well. So if you've got a whole lot of units in the pipeline and you're buying a unit there's really no exit out of that unit in the foreseeable cycles, right? But you would be able to, at some point in time, get out of it, right?
Depending what your plan is for it. But you see the same thing with houses, right?
Exactly.
You know, greenfield land developments where you buy a brand new house, you probably buy it at a premium, but there is still another 5 and 10 years of land releases incrementally, you know, in time, you know, another kilometre out, and then your house becomes old. It's not the new one anymore, and you're going to have a similar price for buying new. So it can compromise it as an asset. But again, if you're the principal place resident, you're probably making different decisions. But maybe there's a bit of misinformation around this, Victor, because if you go into your social media, most people will say, don't buy a unit because the value is in the land component. It's not in the unit component. What do you say to that?
That argument's been there forever, but it's more amplified now purely because of the rent we had before, which is a lot of new players coming into the market. They haven't seen as many cycles to see how it maps out. And they're really looking at the data set in isolation in terms of, let's look at what skewed the data over here, right? And what skewed the numbers. So we went through COVID where everyone's in lockdown, and therefore the not so well located units, not so well placed units, they were ditching that and moving into the suburbs, getting a bit of land, right? Because you can imagine, right? So you're working from home, you've got a 2-year-old screaming in the background because they're trapped in the unit. It's hard. So the natural progression was that the demand moved to houses. And to compound that, we had the 2.5% interest rate, which made the houses reachable for more people than before. So the demand increased. The supply still remained the same, if not less, because we're not constructing as fast because construction came to a halt, right? So yes, the houses shot up in value abnormally, in if I can say that word, in terms of
Abnormally. I'm okay with that.
Let's say that 5 times. So the houses went up quite significantly in value, right? And the units remained the same, because there wasn't as much demand. So
and everybody was scared, living from, imagine the Melbourne COVID lockdowns, right? So this is put a negative.
People wanted sort of breathing space, right? And it took the shine off it. And I take the point because everyone goes, well, I'm going to need moving forward a larger house because I'm going to be working from home permanently, and my house now needs to have a Zoom room because I'm going to be spending all my time in there. Things have changed.
So now we're starting to see the first snippets of change again, where the New South Wales government basically said, come back to work full time, right? Come back to the office. So that'll now mean that we're now starting to move back into the units. We don't need the house because we actually need to look at travel time now. And so the units start coming back into play again. And importantly, because of the big discrepancy now between houses and units. So let's take Sydney as an example, right? Traditionally, the difference between median price units and houses, about 16 to 21%.
Yes, that's what it is.
At the moment, it's sitting at circa 61%, right?
Sorry?
61%.
So what's the number, Reshmi? It's
16 to 21.
Is the normal disparity. So if a house in a suburb is worth $1 million, a unit in that suburb would be
$200K less.
$200K, yes, And so, now it's
61.
So you're paying about $400 to $500K less now, right? So
the gap's widened. So obviously the units are going to catch up. Either the houses are not going to come down because of the lack of construction.
So the houses won't come down because of lack of construction because there's not a lot of stock, and therefore they might not grow at the same speed. However, they'll probably stabilise at the price point.
So even if the houses came back by 5-10%, it's still a 50%
gap.
But are you saying, just to challenge, I get historically it should be a lot closer. It's not anymore. So just going, it's going to have to catch up because of that. That's to me not enough.
No, it's not.
It's not enough.
So we need to obviously then look at what other factors are going to influence that, right? So this is the most employers are starting to bring their employees back into office, hybrid or full time. Then we've got the increased migration, which is also putting pressure. Finance is slowly starting to become easier, and the dust from COVID is settling where people are saying, you know what, yes, I did go out in the burbs, but I really want that lifestyle. I want to go back into that area. So they're moving back into the units, right? And because of the higher interest rate, it's harder to get into houses because it's a larger loan amount. And the rent may be relatively the same in comparison to the unit. So depending on the area, they may say, you know what, I'll get into the unit because that's what I can get into. Or the rental pressure may increase. Now, the flip side of it is obviously the supply and demand scenario, right? Like if you look at Liverpool, we're just driving through there.
Yeah, oversupply, and there's so much more planned to come through. So
But isn't Liverpool supposed to be one of these?
It's supposed to be one of the hub, yes.
6 cities, is what they're calling it? 6 cities? I get
It's
that.
a tale of 7 cities, I think.
Yeah.
it is, yeah.
So, yeah, Livo's one. Livo, sorry. Liverpool. Livo's one of them.
Yeah, Liverpool, Parramatta, Campbelltown, all of these areas.
Central Coast, I
Central
think so.
Coast, yeah.
Yeah.
So, but then again, we also need to be looking at it not just in case in the scenario of just, I've got to buy a unit because, it seems to be the thing to do because of the gap. We also need to look at what's happening in that area. And a really easy way to future-proof your purchase is look at what brand new is selling for.
Yeah.
And buy the older, more robust stuff with better floor plans. And there's a gap, right? So when the market does move, this will catch up to where the new price and the new ceiling will be
I haven't
created.
been through, and Liverpool's a good example. I'm semi-familiar with Liverpool. I haven't been there for many years, but there's some high-rise in Liverpool now, like a 30 stories. 40.
Yeah, I think they allow 30 stories.
So imagine it's a really tight zoned area for high density there, because the rest of Liverpool is just sprawling suburbs, right?
Yep.
So they're going to put all these things up, and then
They're already going up.
They're already going up. So maybe not the right time to get into it now, because they're
Not
going to
in
keep
that
pushing
market.
in that market.
Yeah.
But you sort of red brick, old or blonde brick stuff out there is probably really good buying, I would say.
The
at
stuff
the moment.
that you can't break, the stuff that won't have the...
No lifts, no pools, no
pools,
gym, no concierge. And you've got to question, look, it's getting better, but there's still some of the building practices is questionable. Yes, there's greater regulation around the materials they're using, but there is still a lot of these places going up very, very quickly, maybe to not the right integrity of building. So it's one of these buyer beware type of scenarios and situations. But the question I have for you guys is, maybe for you, Reshmi, is we're talking about affordability thing here. So you got into your first investment property, or investment properties was units. My first investment property was a unit in Mount Druitt. Still have it today. I don't know what that thing's worth right now on Carlisle Avenue.
Hardly anything, man.
Yeah,
they don't go up in price.
They don't go up in that.
well, we sold our first one.
Yeah. But so we still got our original one. It was affordability point of view. But pretty quickly after that, we're buying houses. But I don't know if it's misinformation. I don't want to call it that, because there's some right and wrong elements around houses versus units. But this consensus that you need to buy land rather than a unit. So the question is, are you better, if you've only got so much money, are you better off deploying that in a cheaper location and buying a house versus putting into a unit in a more desirable location? So that this is the point of the value is not in the land, it's in the location. How do you make those decisions, Reshmi? Because it's hard.
Well, what I do is I look at the few other questions like what, where, when, how, and who sort of thing. So I go through all of that in order to decide. So it's coming to a point of where the property is, not only just that, the location-wise, where in your buying cycle you are in the timeline of your own portfolio. So if it's at an entry point, or are you in the midsection, or are you buying later down the investment journey? So that's another thing to look at. What I also look at is who is buying, like which entity. So there's a lot of things to look at before you can really decide. And it's this is where going further down the track, like at what age also you're buying it. So there are quite a few factors, whether you'd be buying a unit or a house, based on those questions that I go through in order to say whether it's a good buy, whether I should be buying the house or the unit. So it's quite a few things, and Victor can go over. Yeah, go on.
I'm so eager to jump in.
Yeah.
We finish each other's sentences.
We do. So cute. Just exploring what you said in terms of age, right? And there's no hiding from the fact that in the immediate, houses tend to grow faster, right? So from the short to medium term, houses tend to grow faster. But units do catch up, give it enough time.
Yep.
In terms of, obviously, we're starting with a lower base, so the figure does not appear as dramatic. But percentage-wise, relatively over 30-year span, they do end up relatively in the same. Because you've got to look at all of the costs involved in holding the property, right? Not just the baseline figure of I bought it for 500 and it's now worth 1.5. Okay, what did it cost you to hold for that long? And it depends on the selection of the asset, right? So if you are starting later in life, knowing the fact that your short to medium term, the unit may not correct as quickly as houses or go up in value as houses, then perhaps you need to start with a house, right? Start with a house first so that the heavy lifting's done. So you've got the get out of jail in case things don't go your way. Because one of the things that most people do when they're investing is they put on rose-colored glasses and they say, you know what, it'll all work out. Our approach has always been, what if it goes pear-shaped? How can I get out of it, or how can I support this to give it enough time, right? So if you're older, you would then buy a house first and then complement with the unit if it makes sense. But if you've got enough time, if you've got 20, 30 years behind you to wait for the fruits of your labor, easy way is to buy a unit as part of the portfolio, and making sure you're not buying in a heavy density area, not buying high rises, not buying.
So you still need to buy unique
Yes.
with units.
Yeah.
Yeah, don't buy the norm. You've got to buy something unique. And unique is going to be dependent on the area. But we're talking about livable there. Unique is probably the walk-up 2-level
Correct.
red or plum
No
brick
lifts.
buildings, no lifts, no nothing, right? That
Yeah.
and that's the long term. So are we talking about buying the upside of the gap at the moment? So this accelerant of capital growth purely to get it up to where the traditional historic norm is of, was it 16 to 21% disparity between the two?
And let's say halve it, right? So it's sitting at 61% at the moment, and let's say that the difference will remain at 30%.
Yeah.
It's still a 30% gap you're going to pick up.
Yeah.
Now, whether that gap gets filled in the next year or next 10 years,
I was
we
going to
don't
ask you,
know.
how long is it going to take to close the gap? And what's going to
so,
drive the gap close?
Did you bring the crystal ball?
That's what you guys do for a
we bought
living.
it in Kmart. Yeah. But we've used our crystal ball a lot more.
Sorcerers, yeah. but like, you know, what you want to do is buy in a place, because you're not going to be able to manufacture the growth. You got to buy the location.
Yeah, you can.
Your infrastructure's coming in as well with metro and all, right?
Yeah.
So that's going to be positive towards that.
And that's for Sydney, right?
Yeah.
But then also other states as well, we need to be looking at what else is coming in.
Yeah.
But in manufacturing the growth, we manufactured the growth on one of your units.
We did, didn't we?
Yeah.
We did a 3-day.
The weekend reno.
A 3-day reno on it. Yeah. It's I actually did most of that work. You just popped by and
I
with a couple
drove
of
by.
coffees.
No, I didn't buy the
You
coffee.
didn't even get out of your car.
I waited until the coffee was there, and then I drove
And then
up.
you just arrived.
Yes, that's right.
I'm actually thinking of doing another 3-day reno on a property.
Good luck.
Yeah. I don't know if it's possible these days.
Tradies.
Tradies is very hard at the moment.
Yeah,
right?
I got tradies.
Okay.
I got some
You got
people.
connections.
I got connected. I'm like, No, but I'm going like to actually line it all up. Like they go boom, 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 boom. You've got to be tight, right?
Oh, yeah,
like,
yeah.
'cause you got to get tiling done, you know, all that sort of stuff, and kitchens and all that sort of hullabaloo, right?
And managing the egos.
Good project management.
Good project, good. So I'm thinking about it, doing another 3-day reno, see if it's possible.
We should film it.
Maybe. Could do.
Yeah.
Yeah.
It'll be interesting.
Yeah.
Yeah.
I don't know if but now I just go, I'm going to spend my weekend painting. I'm going to hang out with my kids.
I could not think of anything worse.
But you just get a couple of painters in, and you know, I liked it. But you can actually manufacture.
Yeah, you can. You
Yeah,
can.
and that's manufacturing capital growth, but it's also manufacturing rent growth, right?
Yes,
and,
that's
and
right.
often
Yeah.
it's under. Do you think rents are undercooked in apartments or units at the moment?
Depends on the area.
Yeah.
Yeah, it depends on the area. You know, Dockland is an example.
Oh, don't talk to me about Docklands. I was down at Docklands 2 weeks ago. I had to head down for a meeting, and there's a small amount of commercial down there. The Docklands was set to be this, like, this is the future. This has got to be Melbourne 2.0, right? Like, it's where all the action is. And I think National Australia Bank is down there. You got the Etihad Stadium right down there on Docklands. It was depressing.
It is.
Like it was
Yeah, I've been
genuinely
there. Yeah.
depressing, and they're still building stuff. And go, what are you guys doing? Like, that no one was there. I think it's empty along the I guess the boardwalk area there. Only one restaurant was open out of probably maybe 50 to 100 retail shops. It reminded me of a once thriving Spanish town on the Mediterranean, which is now destitute and all closed up.
But that's what Victoria is at the moment, right?
Yeah. It was really, really depressing. You know, I was going, all these people have been sold this dream buying these apartments. I didn't even look at real estate, but I imagine there's hundreds.
There's heaps there.
Hundreds available.
Yeah. So big tell, never buy off the plan, especially units.
Yeah.
I'd probably be able to swallow a bitter pill and say, yeah, house and land package is okay in the right location.
Yeah.
But off the plan units, I'd probably shy away from.
Unless it's a unique
Yeah.
Plus
build
it's
somewhere where there's
major
nothing
complex.
else.
Yeah.
Major complexes.
Yeah, and they're ugly. Well, so some of them are okay. The architecture of some of those places, like, God.
No, they're not
Why
ugly.
would you want to
They're
live
interesting.
there? Yeah. But Melbourne still hasn't, no, that's Brizzy. No, Melbourne hasn't said public service workers got to go back to the office yet,
it's,
right?
it's only here.
It's only
In
here,
New South
right?
Wales, yeah.
Like that should fill up, you would think, with young professionals when they come back into the office because you can walk everywhere. But until that happens, I can't see, students aren't going to live down there because there's nothing to do.
Yeah.
You can't go eating anywhere. You know, it's. I was talking about Docklands before. I think it
is pretty much a ghost town at the moment.
It's a ghost town. It's a white elephant. Is what it is. It's
But
an absolute white
that'll turn,
elephant.
right? When the hype
yeah,
returns,
yeah.
it'll turn.
So you're saying you should buy in Docklands? No, Victor Kumar.
Remember, only when you see green shoots.
Yeah, and there's no
not
green
there.
shoots there.
There's
yet.
no green shoots
No.
on the unit market there in the inner city ring.
Yeah.
But we've been buying units in Victoria, well-located units, well-located townhouses. So when I'm saying
Older
units,
school
we're
stuff
saying
you're talking
units,
about.
Yeah, this is like calling like micro markets.
Yes.
That's what we're looking at. So
Yeah,
can't just
absolutely.
generalize it overall and say not to buy. So
And by units, you're pretty much saying some of that strata. So it could be a townhouse, it could be a villa, it could be a traditional apartment.
Yep.
Yeah.
It could be a duplex.
Could be a
right, both
duplex.
sides.
Yeah.
So they do exist as well. The numbers need to make sense, right? So buying well located, so next to a uni, next to a hospital, next to an employment hub or lifestyle area, makes sense, right?
See, I would say places like, and again, I'm generalising, Parramatta CBD, I'd probably be shying away from it, or Parramatta. A lot of people bought units in Parramatta probably 7-8 years ago, 10 years ago, up and down Church Street and all over the joint. It's now starting to sort of pick up a little bit. It's getting a little bit more gentrified. They fix up Church Street more. It's a lot nicer. But I reckon a unit in Westmead near the hospital is probably like a cracker of an investment.
Yeah. We've bought units in Parramatta in 2 cycles ago for our clients, right? And we picked them up between 250 to 350K, and we capped out at 450.
Yeah.
The reason we capped out at 450 was at that time, brand new was selling for 700.
Okay.
Right? Obviously, they're fleshier looking and all that. Now, because those brand new ones, 10 years, 15 years down the track, is now starting to resell again and changing hands, it's dragging these ones up as well over the period of time. So having that, so we're talking about gaps between houses and units, but we also need to be talking about gaps between units. When I'm saying units, I'm talking units, townhouses and villas and all this stuff, so all in one, right? So we need to see the gap between the old and the new as well. So you're not paying, on par to what brand new is selling for, because the brand new creates a new ceiling in that area, both for rent as well as for price. And if you've got enough gap there, you've got 2 things working for you now: the house plus unit discrepancy, and the new unit and old unit discrepancy.
So who's buying the new units?
People buy fleshy stuff.
Yeah, that's just the way it is. Yeah, thinking it's a good investment.
Yeah.
These are probably the property investors that only own one
property,
investment property.
Which is about 1.8 million.
And I'm not
investors
generalising, but just saying, just saying because you think about the cost to hold these, right? Like a cost to hold a house versus the cost to hold a unit. You got, the house and stuff. You still got your council rates and all that sort of thing, but strata fees in some of these newer, more larger blocks, it's big bananas, right? Big bananas.
You really need to be looking at it from when you're getting into the property, do your research, right? So if you're buying a unit, look at what the strata fee is, right, to begin with. Don't just look at the baseline figures. Then have a look at the minutes in terms of what repairs are flagged, major repairs, what repairs have been done, have there been special levies and all. So there is a bit more due diligence that needs to be done rather than just saying, oh, that unit looks flashy and it's in the right location, let's buy it.
Yeah.
Units in front of water, obviously, they have a higher maintenance, so you need to factor those things in as well. Same as houses.
Yeah. Yeah. So how do you, Reshmi, go about identifying where to buy units? What would be your recommendations? What are the key? So you're obviously trying to find areas where the gap is disproportionately more than others and trying to understand or rationalise why is that the case? How do you find that?
Lots of research.
Yeah.
Apart from that, you look at the way the prices are sitting for the new units in the different areas. And because we're getting into the established and the newer, the older style like units, like the 2-story highs and all that. So if you can see that with that disparity, if you'll be able to sense that, okay, this is a good buy, and plus the fact that it will be located within those infrastructure and those things that we talked about, the hospital transport and all that. So
Lifestyle.
The location of that. So that is what you would look at. Plus, not only that, I'll just take one step back. It's like to buy that, whether that particular property is going to enable you to move to the next step in your investment portfolio. So that's also a point to look at. So if it just fits your affordability, but then it does not grow, then you can't move to the next property. So there's quite a few things to look at before, to decide whether that will be a good one. It's those few key points, like where it is located, what's the infrastructure, what type of people are moving in and out, what's the disparity between the old and the new, and the cost. There's, as you said, trying to avoid huge demand, huge oversupply, and where the demand is high, migrant community, especially when they come in and they're renting.
Yeah, this is, and a lot of new to Australia migrants, they move out into these areas, which typically they go into a unit first and then hopefully buy, and that's a good driver and enabler. But you talk about infrastructure and the new metro in Sydney's just opened up this week or last week, I can't remember. I heard, and I'm probably going to get these numbers wrong, but this is what I remember, is from announcement to it being open was 13 years.
Yep.
So
that's a long time to wait for infrastructure.
It's a long time to wait for infrastructure. Yeah. So people that owned property near the metro before it was announced and then it got announced probably went, that's pretty cool. But then people strategically buying around it going, and to capitalise. And that's a long-term play to park your dough.
Yeah, you've got to look at it from a long play, right? So if you look at it statistically, most people sell out of their investments within the first 5 years of ownership because they've done two things really wrong. One, they've fudged their figures in terms of ability to hold on to the property, right? So do the real figures to begin with. Then they are impatient in terms of growth, right? So first thing we do is take the speculation away. So if there's a promise of infrastructure, that's not the reason to buy. Yeah, you need to start turning dirt, right? So yes, you're going to get in a little bit late and pay a little bit more, but there's more surety in that. So if that's going to be the catalyst, let's take the catalyst away and say, okay, does it still stand on its own two legs? And if it does, then you move on to the next stage of researching that. Yeah.
It's again, I like units. As we spoke about, I've been looking at it for some time, and this disparity, but it's still questionable. What needs to happen to close that gap? And if you think about in Melbourne or Docklands specifically, but Melbourne in general, is to close the gap between that value. Some pretty seismic things needs to happen. Yes. I would probably say a change of government's one of them. But you can't plan for that. You can't orchestrate that. You're just a passenger. So, again, it comes down to how you choose to deploy your money at any point in time for the upside values you want. So, I take your point. You're probably better off kicking off with houses if you can afford it and then get some units into the play. Another big part of this, and we haven't spoken about it, and you guys obviously have a mortgage company as well, is that often there is restrictions around borrowing for units, Reshmi.
Yes, it is. That was the point I wanted to point out as well. Like lenders won't lend, like depending on the size of the unit and how many in the complex. So you'll have to be very picky with which lender is going to lend you. The LVR, which is loan to value ratios, are they vary, and so if a lender is not very keen to lend, that will be a big problem.
And some lenders absolutely have postcode restrictions.
Yeah,
I don't know.
absolutely.
I reckon some lenders won't even touch Docklands. They'll go,
No, so with postcode 3,000, 3,000, and it's ancillary postcodes in the inner ring. The lenders might put some restrictions on it, and so if you need to think of it logically, right? So if the lender is, having kittens lending you the money, where are their buyers, right? Because they'll need to borrow the money to buy it, right? So if you're making it harder for them to get the money by selecting the wrong asset, then obviously it is the wrong play in your portfolio. So if you look at it from normal cyclical point of view, as we start getting into oversupply, particularly the inner city ring and the city itself in all areas, so this is all states, the lenders will start putting restrictions in terms of loan to value ratio because they know that the supply will be outstripping the demand, and both from rent point of view as well as from a purchase point of view. So stay away from those traditional historical LVR jumping around scenario and go into the more stable areas. But equally importantly, if you found a townhouse and the bulk predominant tenancy preference in that area is houses, you're buying the wrong property.
Yeah, that's a really important point. So certainly, I think back in Sydney, certain locations, all you can buy is a unit.
Yep.
In other places, all you can essentially buy is houses. Units might not be available. And this comes back to developing. You don't develop units in areas where people don't want units.
Correct.
So you don't want to be buying outside of what is considered normal in those areas. And it's a really important point. And if you think of the new metro out towards Rouse Hill Way.
Yes.
What's that metro called? Northwest? I don't know,
Northwest.
Around Northwest, right? Let's talk about Northwest because if you come up Windsor Road, you've got the whole new, the original Northwest that was built, but the bit before it now, they reckon it's going to be a city of the future, right? It's going to be high-rise, mega city there.
Yep.
Surrounding the whole area is still suburbs, like Kings Langley and Borkham Hills and the Ponds. The Ponds median now is like 1.3 or something or other, right? So, how do you know when's the right time, or would you be buying in those areas? Because, to sit around and wait for these cities of the future, Badgerys Creek, for example, cities of the future, it's pretty speculative.
Yeah, it is. And this is why you never buy purely based on future infrastructure coming in. I remember that when we first migrated, we were seeing these signs there saying no airport in Badgerys Creek. And I'm thinking, what's Badgerys Creek? This is back in 97, right?
So when you should have bought land out there, one of those market gardens,
Yeah, but then
there's
we
a lot of very wealthy families now.
True. But, in terms of our portfolio, if it bought land, that would have locked us out in terms of buying more investment properties at the time. So, hindsight's always 2020. Yeah. But you'd never buy anything, houses, units, based on future infrastructure. It needs to be here, right now, because then you can de-risk it as much as you can.
So you're saying if you're buying units, it's got to be established.
Correct. Yeah. There needs to be... So what makes an area grow in value, right? Forget all the infrastructure. Forget the hospitals. Forget the schools, right? That's all normal stuff. What most people don't look at is then, within 20-minute driving distance, how many employment hubs have we got, right? What type of employment? If the area is predominantly, single income families or Centrelink benefit, then there's a natural cap to the rent. So therefore, the yield is impacted. And when the yield is impacted, of course, price is impacted as well. The prices can't go up as fast because people that are in that buying pool in that area can't buy. So we need to be looking at the income side of that area as well. And that then helps us get a better surety in terms of growth.
So if your buyer's agent says, don't buy a unit, units are bad investments.
I'll ask them to qualify it first. And if they can't, I'll say, go wash your mouth with soap.
So you're back at so Victor Kumar and Reshmi Kumar are back in units at the moment.
Yeah. No, we've always been buying units.
And listen, it's not a new thing,
it's
right?
not a new
it's
thing.
Just it becomes it's just a bit more attractive these days.
It is, especially with that negative news always brings opportunities, right? So the negative news at the moment is that units have not grown in value over the last 4 or 5 years, right?
So
but
what's on the
forgetting
other
what the
side?
cause is. What the cause is. The cause was largely COVID, right? Which has created that big spurt of growth. So buying a unit, given today's day and age of hard to qualify for finance, and knowing that when that corrects, there will be another growth spurt because we've got very recent social proof of really good growth. So when people can borrow money, they'll jump in. And let's say a house is going to cost you 800, you can only qualify for, say, 600. And that 600 gets you a well-located townhouse. You'd get into that because you know that growth is coming. It's just a matter of time.
Yeah.
Within your means, though.
So which units, either of you guys can answer this, which locations are going to grow faster in units than others?
Well, for that, you have to...
Call 1-800 Group. But there's got to be some areas that's going to grow faster than others, right?
Yeah, absolutely.
And that's what you're looking for.
That's
right
what you're
now.
looking for.
And you know where that is, you're just not going to tell
We're
me.
not going to tell. No.
Is there any in Sydney?
Micro markets.
There is, yes, absolutely. So,
Is there any within 2 or 3 kilometres of this location?
Oh, you showed me a couple of units. So you need to look at the uniqueness of it and who your end user is, and if you need it to sell, whether it'll be a quick seller, right? And also where there will be a ready market to buy it off you. Getting in is very easy. Yeah. It's the get out you need to look at first.
So a lot of people get absorbed or obsessed with this, and we talk about the metro here, it's just up the road, walking distance. There is a unit complex pretty much right next door to that, and I drove past it today. I reckon, 300 to 400 units in it. Like it's big, looks quite nice. There's restaurants downstairs. It's and even the metro now, there's a whole underground area there which is just for bike parking. Yeah. So they're obviously expecting you wouldn't go near that stuff with a barge pole.
No, because of course, if I got it for 50% discount, yes, of course I'd look at it, right? But I'd buy a Portaloo on the moon if it's 50% discounted, provided I can have someone to on-sell it to at some point in time. Okay. And someone to rent
Mars?
it. Someone from Mars.
I'm curious now. I'm going to spend some time on units because I find it intriguing. When is what is the right stuff to buy, and that's what we're talking about here.
And we're not banging on saying that you must buy units, right? I'd say don't discount units.
Yeah,
because they're already discounted.
Yeah, they already
discounted.
Or some are.
Yeah, some are.
Not all units.
Not all.
And I think what I'm painting a picture there of this metro in North Sydney. It's a beautiful complex. It looks fancy and
brochures look nice.
Brochures look nice. Like the units we're talking about are probably where you go. One of them.
Yeah, that's right.
That's good. Unit blocks. I like unit blocks as well.
Yep.
So let's talk about unit blocks really quickly. We're running out of time, but is it better to have 5 units in different locations versus 5 units and you control, or 10 units, whatever it is, control a whole sort of block?
2 layers to that question. You're spreading your risk in different areas. And this one as a whole block, you still got all of them in the one area. So your risks are not managed well. But if you've got multiple... like we've got our Friar Roads and the boundary. These are awesome properties and they're in growing areas. So we've got a lot going on in these areas. So we've got, I guess, with our level of investing, the number of years we've had, we've got blocks of units as well as different units in school. Yeah. So it's a bit of a mixture there.
And a whole lot of houses as well.
And a whole lot of houses, because you guys bought us a really good block of units up in Launton.
Yes.
Probably about 2017.
17, 18, I think it was.
Did we speak about this recently? It's all more than doubled in value, all these units. So we bought them for 200 grand each. They're all at sort of 400 and something now.
400 is undercooking it.
Yeah, 450 probably. Some repairs needs doing though. Like your repair bills a lot more, insurance a lot more.
Excuse me.
Comparative.
If I found that a bit hard to swallow.
Yeah.
The repair bills.
By the way, I just got an insurance thing for a property up in same area in Kalanga. So it's up by $1,000 in a year.
Yes. So all insurance policies have gone up significantly.
Yeah.
Lots of natural disasters and traditionally, a couple of things that happen, right? So one is when you get to insurance renewal, you need to look at what your building component is.
Yeah.
There's an automatic increase, usually depending on the insurer, up to 20% in the building cover. So that increases your premium. And then you've also got inflation. Then you've also got a lot of natural disasters. Understanding that insurance is a policy where the premiums of many fund the claims of a few, right? But we've had a whole lot more claims because of flood, cyclones and all that, so it's gone up.
Yeah, it's not cool.
Plus you're paying a loyalty tax.
You are paying a loyalty tax.
So if you went to a different insurer, now check with a broker, check with a consultant before you do this, because just like health insurance, if it's an existing condition, it's not covered. So if your tenant's in arrears, you change insurers, you're not covered.
Yeah, that's important.
Yeah. So if you go to a different insurer, you may get a initial discount, and then you could revert back. But just look at the fine print.
Lots of stuff there. All right. So if you want to talk about units, you guys, you have to talk about units. Yeah. When would you actually say to someone, you sit in front of me going, have you thought about buying a unit? What would you see to go smaller deposits, a bit more established, looking to accelerate growth? It's a capital growth play at the moment. It's about buying the gap.
Absolutely.
Yeah.
And it comes down, it's not a blanket approach. It comes down to the person, the circumstances, and what's the best fit. Right? And that's what we do, is try and get you the best fit based on your circumstances, based on your financial capability, and then we map it out in the market.
Okay, good. Well, thanks for your time, Reshmi. Victor, it's good to see you guys.
It's always good to have stimulating conversations.
Now, you're going to come have a chat with me on the Smart Point Investment Show around our portfolio as well.
So you're going to lay out the steak knives as well?
Yes, I will do. Okay. I will do. No, it's good to look forward to that. But so if you haven't yet registered, or if you want to register for, it's only in Sydney at the moment, Right On Track, which is Tuesday of next week.
3rd September.
Yeah, so you still got a couple of days to register, rightpropertygroup.com.au. Go and check that out. But otherwise, people can just get in touch with your team and they'll have a yarn with you guys.
Absolutely. And so there's a little bit of a process. You speak with Melissa first. She makes sure that we are right fit and gets you really thinking of the curly questions you need to be asking yourself before you engage our services, and then we can then start talking strategies and start implementing.
All right, great. Thanks for your time.
Thank you.
Rightpropertygroup.com.au. Go and tune into a lot more podcasts just on this network, Right Property Group. Go and Google it and find it on the Apple iTunes. Knock yourself out. We've been doing it for a lot of years. So I enjoy it. It's great fun, and we'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.